One Paul here. Today I'm going to go over a strategy. If you saw my last video, it is a moving average strategy and it works really well. I showed you how to do it for trading crypto with it. Today I'm going to be showing you how to do this for the stock market. Mainly we'll look at SPY, maybe we'll look at some other assets. But basically how to apply this moving average strategy with another indicator to get the best out of trades. The focus here is to, focus more on longer time frames because it works the best with longer time frames. You can do this with smaller time frames, but you run the risk of hitting consolidation areas and things like that. So this strategy works the best for the longer time frames. So anyway, let me show you how to set up. We'll look at SPY and we'll look at some other stocks. Okay, so to set this up, you need two indicators. You're going to need you're going to go here to indicators, and you're going to go to three smooth moving averages, and you're going to input three different numbers for your moving averages. So right here, you're going to go and you're going to put in 9, 21, and 200. Now what I do is I make them stand out, I make them bright, and the 200 here I make more thick because this is basically just used to show you the overall direction where everything's going. So once you have that set up, you need another indicator here on the bottom, and that is called the trend. It's called the Trend Strength Index. So once you have, those are all four of the indicators. So once you have them set up, you basically have different ways of trading here. The first method here is just by going over the moving averages alone and basically following. You can follow it every time the 9, the 21, and the 200 cross. So if you're doing this on the day chart, we'll start with the day chart, but the further out you go in the time frames, the less time that this is going to happen. So if we look at the day chart, we'll look at the last time that it crossed, and we'll look at it, and the last time it crossed was right here. So this was on March 27th. So if you came in at this point, and you could have rode this entire thing. Well, with contracts and all that. But basically, if you did this on Forex and you were able to ride this whole thing, this would have been a very expensive contract. But if you did this on Forex, you would just been able to ride this entire thing out from where we are now. So for the sake of this video, I am just going to show you how much profit that is. We'll look into contracts, but I'll show you how much this would be if you did it on Robinhood. If you rode this entire thing out from here to here, from the moment it crossed, we would be looking at, well, this would have been a lot. This would have been a pretty big trade. So anyway, if you followed it on the day and you rode it out all the way till here, you would still be in profit. So that's basically what you do for that scenario. So let's just go back and zoom in a little bit closer. You got right here, it crossed right here. But your 921 crosses right here, so you could have got in right here and rode this little small one right here. See the 921 crossing right here, and you could have rode it out for till here. Could have made some profit there. And then you also see it crossing down here. It's below it, and the 921 crosses, so this whole thing right here could have been profit. From here to here, you would be in profit. Now that's doing it on the day. I like doing it, but this disadvantage here is you got to wait for the cross, and that's going to take some time. So if you want, you can go down on your time frames. You can go down to your 6 hour. It's the same thing. You follow the moving averages. You look for crosses with the 921, and you look for crosses with the 921 and the 200. So it's good that all three of them are crossing. They don't all three have to cross. Just the 921 has to cross, and it has to be going in the direction of what the 200 moving average is doing for the best results. So that's the first part of the strategy, is to use it and use it with the moving averages and get in when they're crossing, basically. So here I'm going to teach you real quickly how we use the trend strength index for this. Let's go back to the day here. So the first thing we want to do is identify what's the overall direction. And the overall direction on the day is up because the candles are above the 200 moving average. So the overall direction is up. So if you want to focus on trades that are going up, right now we have been going down, and the moving averages have not crossed yet. So it's not a good time to go in a call position right now because it's in a little bit of a pullback. But if you want to get in on little scalps, we know the direction right now is up. So you want to look at your trend strength index, and you want to focus on the moment when it's crossing up on the zero line. So those would be moments where we would enter trades. So if you come in right here, right about here, we see it's crossing the zero line right about here. So you could have come in this trade and exited about here. You would have made that's $1,211. So if we focus on every time it crosses the zero line on the day, is a good profitable trade. These are trades that take for a couple days. So right about here, if you rode this one out from here to here, this one's about $2,000. You see another moment right here. Right here we see it crossing the zero line. You could have entered here. You could have rode this out, and this would have been about $1,530. You see another moment right here, crosses the zero line right about here. So you could have come in right here on this candle, and you could have rode this out for a couple days, and this is $1,816. So you can do this once you have identified the overall direction. The overall direction is the candles have to be above the 200 moving average. And once you know the direction, you can focus on that direction. You can keep your eye on the moving average of the 921 and get in when it crosses. Or you can look at your trend strength index and get in every time it crosses up on the zero line. So for bullish trends, you want to look for crossing up on the zero line. For bearish trends, you want to see it crossing down on the zero line, but you would have to confirm that it is a downtrend. So real quickly, we're going to be looking at smaller time frames. This works for whatever time frame you want to use. Just the longer you go out, the longer you're going to have to wait. And the longer you're going to have to wait, and then if you go into a smaller time frame, you're going to hit more consolidation stuff. So on the 6 hour here, what we want to focus on is uptrend. So because the overall direction is up, so could have entered here for a little scalp. Could have entered here for a tiny one. That might be a little tiny, but there's one right here for, you might make a little bit there. You make some right here for a trade. If you entered right here where it crosses the zero line, here all the way to the top, and you would have made some profit there. And then if you keep going down in your time frames, we know the overall direction is up. So the thing you want to look for when you're going down in time frames, you want to make sure one technique is the 921 and the 200 are all crossing each other. That's a good signal. It's also a uptrend that we want to focus on. So we see it happen right here. There's a little profit right there. Here's a tiny one here. I probably wouldn't go in that trade because it's a downtrend at that point. These are hard to get in for. These are going against the trend pretty much. But you got a moment right here to get in for a trade. You got a moment right here to get in for a trade. You got a moment right here to get in for a small trade. You got a moment right here to get in for a small trade. So these are the moments to enter trades. So that's basically what you do. You get in. You have to, first you want to look at your moving averages on the longer time frame, and you want to identify what the direction is. You can also, with this strategy, kind of figure out where the bottom is going to be. So on the day chart, if you see it on the 200 moving average, you know that the bottom is pretty much about $534. So if the candles get close to $534, it's probably going to bounce pretty much from that location or close to that location if there is a pullback. So you can use your 200 moving average to kind of see where the bottom's going to be. And if this is a bear market, you can kind of see the bounce zone of where it has to go through to be bullish. But anyway, though, that's just kind of how to do the strategy. You want to use your 9, your 21, and your 200, and you want to follow them. You basically, you either want to find crosses where all three of them are crossing, and then you want to identify direction, and you want to use the 921 to get in at moments when those lines cross. And if you want to go further, you use your trend strength index here to find good scalping moments.